Welcome back to Investing Talk Podcast.
Today we're looking at Dragonfly Energy. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. This one's really interesting because, well, the volatility alone tells quite a story, doesn't it? Lots of investor emotion here.
Definitely.
We're basically looking at a company trying to scale some pretty cutting-edge tech, but they're doing it under some serious financial pressure.
Yeah.
The recent price moves, especially after those capital raises, well, we really have to start with the big headwinds, the losses, and that significant dilution.
It really is extreme volatility. I mean, you see the price now around $1.13, and it almost feels detached when the 52-week range goes from, what, 15 cents?
Yeah, the 15 cents. Unbelievable low.
All the way up to over $5.50. That kind of swing shows just how much sentiment has flipped, but investors are clearly still very nervous. Why is that?
It really boils down to the financial structure, or maybe the lack of a solid one right now. The balance sheet, it shows serious stress.
How serious?
Well, when you look at the numbers, the big thing is negative equity. The debt-to-equity ratio is, well, it's minus 254.2%.
Wow. Minus 254%. So for you listening, negative equity isn't just debt. It means liabilities are way bigger than assets, right?
Exactly. It signals real financial vulnerability. Kind of implies they can't even cover their debts by selling everything they own.
Which forces them to look outside for money just to operate?
Precisely.
Yeah.
They're reliant on that external funding, plus they need cash for growth investments. And you see the result in the losses. Trailing 12 months, it's a net loss of $30.45 million.
Okay.
Which translates to an EPS, earnings per share, of negative $3.63. Now, management says they have enough liquidity through 2025.
But
with ongoing losses like that, that timeline shrinks fast unless they really improve their operational cash flow.
And I saw the revenue drop, too. Fiscal 24 revenue fell, what, over 21%? Down to about $50 million?
That's right. Yeah.
$50.65 million.
The sources mention channel destocking. Can we pause there? What is that exactly? Is it just a temporary blip or something more fundamental about demand?
Good question. It's important to get the difference. Channel destocking is usually temporary. It's when the retailers or distributors, the channel, cut back on their inventory.
Okay.
Think about it. After the pandemic buying surge, lots of sectors, especially RV and marine, probably over-ordered. So even if people are still buying, the distributors just stop ordering for a bit to clear out their warehouses.
Ah, I see.
The sources seem to view this as an industry thing, not just a Dragonfly energy problem. So the hope is, once that destocking is done, sales should pick back up. Hope isn't much of a strategy when you're burning through cash like that, though. And they definitely needed cash, which became very clear with their recent moves, the dilution events that really hammered the stock price.
Absolutely. The market reaction was instant because, well, dilution confirms that financial distress we talked about. There were two big ones pretty close together.
Correct.
First, back in August 2025, they restructured debt. Yeah. That involved issuing $25 million in Series B preferred stock.
Preferred stock. Convertible.
Yeah, convertible into common shares at $3.15 per share. Now, that price is way above where the stock is now, but it still adds potential future dilution. It just kind of hangs over the stock.
So that was like the warning shot. Then what happened in October that caused that huge 20-25% drop?
October was the big one. They did a major public offering, sold over 20 million shares.
20 million, wow.
Yeah, and at a low price too, just $1.25 a share. Raised $55.4 million.
Yeah.
But for you, if you're holding shares, that's painful.
Because suddenly there are way more shares out there. Your piece of the pie just got smaller, diluted.
Exactly. The market reaction was fast and pretty brutal. Lots of skepticism about their stability, even with the new cash.
Seems like a steep price to pay in share value just to get that capital. Why now? And where's that $55 million actually going?
It's earmarked for basically three critical things.
Yeah.
Working capital, just to keep lights on and operations running. Then a big chunk for R&D.
The tech side.
Right. Specifically, their next-gen solid-state battery tech. And finally, some mandatory debt repayment. It's a lifeline, really. But the market's asking, can they actually execute well enough with this cash to make up for adding all those shares?
So it buys them time, but no guarantees.
None at all.
Okay, so that's the risk side. It's pretty stark. Deep negative equity, burning cash, massive dilution, punishing shareholders. It's really hard to square that with analysts calling it a strong buy and seeing triple-digit upside. That's a huge disconnect.
Yeah.
What's the core strength? What's the bull case here?
And this is where you have to pivot. You look away from the scary balance sheet for a moment and focus on the innovation and their place in the market. That's the whole bull argument.
Okay.
Dragonfly Energy is fundamentally a recognized innovator in deep cycle lithium-ion batteries. They're not trying to compete head-on with, say, EV makers.
They pick their battles.
Exactly. They targeted and really established themselves in these high-growth niches. RVs, marine, off-grid, solar. These are actually some of the fastest-growing areas for energy storage.
That focus makes sense. They dominate specific high-value areas where things like durability and lightweight power really matter.
Precisely. And you see proof of that in their operational efficiency. Even with that revenue dip from destocking, their gross margin is strong. It's holding at 25.56%.
And that's good.
That's really good for this kind of early-stage energy tech company. Many struggle to get past 15, maybe 20%. Holding over 25% shows their product commands a premium. It suggests their tech is differentiated and their manufacturing is efficient.
Okay, so that margin is maybe the best sign they have real IP, not just selling a commodity. What specific tech backs that up?
Well, they don't just make battery cells. They focus on their own proprietary battery management systems, the BMS, and the whole integrated lithium power system.
A whole package.
Right. That integration is crucial in tight spaces like RVs, where safety and performance are critical. Plus, they've locked in key partnerships with OEMs.
Original equipment manufacturers.
Yes. So their batteries get factory installed. That puts them right at the forefront of this whole electrification trend in recreational and industrial vehicles.
Let's talk about that big long-term bet. Solid state. Management's putting some of that dilutive cash there. We hear solid state thrown around a lot. What's the deal for Dragonfly Energy specifically?
This is really their key strategic move for the future. You know, traditional lithium-ion uses liquid inside.
Right.
Solid state swaps that liquid for a solid material. The potential payoff is huge. Higher energy density, maybe faster charging, and crucially, much better safety and longer lifespan.
So it's like the next leap in battery tech.
It really is. And they're not just tinkering with it, they're actively prioritizing scaling it up, along with something called dry electrode technology, which helps cut manufacturing costs and is better for the environment. If they can successfully bring solid-state batteries to their specific RV and marine markets before the giant EV players saturate everything, well, that could justify this whole high-risk, high-reward situation. That $55 million is like a down payment on trying to secure that future.
Okay, let's bring it back to the near term. For investors looking at this now, that volatility means potential big swings. What are the key things happening, say, in the next 3 months that could actually trigger a rebound and prove the bulls right?
The next quarter is absolutely critical. It feels like a real make-or-break period. The Q3 2025 earnings release, probably mid-November. That's the big one.
What are people watching for?
Everyone's going to be laser-focused on liquidity and cash burn. They need to show they're getting expenses under control and that the revenue decline has stopped. Interestingly, analyst consensus is actually expecting a year-over-year revenue rebound.
That seems optimistic given the recent numbers. What else could provide a spark?
Keep an eye out for product news before the end of the year. They're expected to launch new products for those RV and marine markets. That could drive some sales.
And maybe some surprises.
Well, there are always speculative rumors. Things like potential new OEM deals or maybe moving into commercial fleet solutions. If they landed a big commercial contract, that could seriously change the narrative overnight. It would shift them from just being a niche player.
Okay, let's look at the charts then. Prices hovering around $1.13. We know there was heavy selling after the dilution. What are the technicals saying? Are big investors buying on the dip or staying away?
Surprisingly, the technical picture looks bullish. It actually suggests accumulation despite that October dilution hit.
Really? How so?
If you look at the moving averages, how the price trends over time, both the short-term and long-term ones are flashing a positive buy signal. It suggests buyers stepped in and absorbed that selling pressure.
What about momentum? Is there any sign of an upward trend starting?
The momentum seems to be building. There's a bullish 3-month MACD crossover. The MACD moving average convergence divergence. It's a momentum indicator. Bullish crossover basically means short-term momentum is picking up steam faster than the longer-term trend.
Okay.
It's a classic sign. The stock might be starting a new uptrend. And the technical outlook suggests a trading range between about $1 and $2.01 over the next 3 months. So potential for real gains if it holds that dollar level.
It's just amazing how that technical optimism contrasts so sharply with the fundamental financial picture. And analysts are still quite aggressive, right? Targets between $1.50 and $2.01. The high end is like 125% upside.
The risk and reward are just massive on both sides here. Yeah, the analysis sources give it a high bullish rating, 8.2 out of 10, but that rating definitely comes with a big warning label.
So if you're listening and considering the stock, how do you possibly weigh these two completely different stories? What does the final decision really hinge on?
It all comes down to execution, pure and simple. Management is walking a very thin tightrope. They absolutely must deliver on those new products. They need to ramp up the OEM contracts quickly, and they have to show they're using that new cash responsibly on the solid-state push.
If they pull it off.
If they execute well, then yeah, that 125% upside starts to look plausible.
And the flip side. What if Q3 disappoints? What's the worst-case scenario look like?
If they miss on Q3 earnings, especially if they can't show a clear path to slowing down the cash burn or if they announce delays in the tech scaling, the downside is severe. Our sources point to support levels way down near the $33, $40.
Ouch. So a big miss could wipe out most of the value.
Easily. And that's highlighted by the crazy volatility, 41% weekly average volat. This is really only suitable for investors with a high tolerance for risk. You have to understand you're making a tactical bet on a turnaround, not buying a steady blue chip. Ultimately, this company is just a perfect case study. It's a bet on massive structural growth, this huge shift to lithium-ion everywhere versus really acute, immediate financial distress from trying to scale up.
Right.
So the question you, the listener, have to ask is, do you trust this management team to navigate this, to execute a turnaround, and use that dilutive capital effectively? Or does the risk of more dilution or even outright failure just outweigh that potential reward in the next year or so?
That really raises a critical question, doesn't it? When you're looking at a stock with these kinds of severe, immediate financial risks, but it also has potentially game-changing technology, how much weight do you put on those near-term catalysts signaling maybe a small recovery versus the huge long-term solvency risk baked into that balance sheet? Definitely something to think about as you do your own research.